Deliberations at the 2025 spring meetings of the World Bank Group and the International Monetary Fund are gaining momentum as African delegations are in Washington, D.C. to chart ways for a resilient continent amid geopolitical tensions stoked by the U.S. tariff. Welcome to Africa Business Weekly, the last for the month of April. I'm your host, Akin Obakeye. Let's dive into this week's top stories and explore what's shaping the future of business in Africa. We start off in South Africa, where the country welcomed Ukraine's President Vladimir Zelenskyy on his first visit to the country. Now, what's the diplomatic implication of his visit to BRICS and the ongoing war with Russia? And then we move over to West Africa, where Togo's economy is recording some commendations despite global headwinds. This and more are what we'll bring to you on the show today. But let's cross over to Johannesburg and get updates from Karabo.
Thank you, Akin, and a very good evening to our viewers. Vladimir Zelensky's visit to South Africa this week marks the first by a Ukrainian head of state to the country. The Ukrainian president's first visit to South Africa comes amid a flurry of diplomatic efforts aimed at securing a peace deal with Russia. Experts say South Africa can serve as a mediator on humanitarian issues. For more on this, CNBC Africa's Zanella Morrison spoke to Stavros Nikolaou, who is the BRICS Business Council member. Let's listen in.
Interesting timing, certainly, but not bad timing either, I might say. I think there are many different layers to this visit. There's, as you point out, there's a diplomatic and a political layer. There's an economic layer. I'm going to focus largely on the latter, not the former. But what I should say is it's timely because the world is starting to get to grips with the tariff and trade. Let me call it, I suppose it is a war of sorts, right? And part of just about every country's strategy is how do they diversify their economies? How do they diversify their economic partnerships? Now, we traditionally don't have a very strong economic partnership with Ukraine. There are, however, some interesting opportunities. For me, the single biggest opportunity in this whole diversification debate is that South Africa's biggest trading partner is Africa. So 24% of our exports go to Africa, and then 22% go to the European Union. So the EU is exceedingly important for us. I think we know what the EU's posture and stance is vis-a-vis Ukraine. They want a ceasefire. Eventually, they want Ukraine to join the EU. So this is, in a large part, about us exploring new economic opportunities, but at the same time, strengthening existing economic opportunities. And it's not going to place us in a bad light at all with the EU if we have a successful visit by President Zelenskyy here tomorrow. And then, may I just add, on the economic part, Ukraine are quite big on fertilizer and grains and maize. And that is why there was a peace mission led by President Ramaphosa 18 months ago, accompanied by another 6 African heads of state. It was very much about food security. So there is that opportunity as well that we need to explore, and a few others, but I'm sure you're going to come to that in a few minutes.
No, but I think the question is, and I want to stay on what you're talking about, is the opportunities in the Ukraine. They are surely also on a journey of reconstruction and rebuilding the Ukraine. What does that mean from a South African perspective that we could be playing a part in helping them to rebuild amidst the war that still needs to come to an end?
The posture of South African business has been very much in the main, because it's not the only part you look at, but in the main to anchor our foreign relations against what's in the best economic interest of the country. And to that end, we need to trade and invest with everyone. We got to be agnostic to the politics. We have to look at where the best economic opportunities reside, and they reside in the east, they reside in the west, and they reside in the south, and that's the posture we take. We've got to remain non-aligned and explore every economic opportunity because we have a pedestrian economic growth, huge unemployment problems to solve, and huge poverty alleviation that needs to take place in our country. So Ukraine does present one of those opportunities. More specifically, we've identified 4 immediate targets. So the first is agribusiness, agriculture, food security. They being the Ukrainians, have some ambitions. They want to sell us poultry. So we're going to have a more detailed conversation B2B on that.
In more news in the region this week, South Africa has abandoned plans to increase value-added tax from May 1st. This after the proposed hike faced opposition from political parties and led to investor fears that the coalition government could split. The National Treasury had planned to raise VAT by 1 percentage point spread over 2 years as part of revenue measures for the 2025 national budget. But the two biggest parties in the coalition government, which are the African National Congress and the Democratic Alliance, have been at odds over the proposal. The VAT will now be maintained at 15%. For more on the implications of this decision, our senior anchor Fifi Peters spoke to Azar Jamin, who is a director and chief economist at Econometrics.
First of all, I think he caved because the whole country was against the idea of an increase in the rate of VAT, most political parties. And even within the ANC, I think he was facing a lot of opposition. Why he caved in is, I believe, that he realized that he was going to lose the court action that the DA had brought on to him, with the friend having the of the EFF situation also being involved in that as a friend in the court action. And he thought, rather than actually suffering the humiliation of having the issue completely thrown out by the courts, he'd rather pull back at this late stage. There was also the whole issue with an agreement that the ANC had reached with the Action SA to find other means of compensating for the hike in VAT, and that Action SA had made it quite clear that they would pull out of the agreement to support the budget if the ANC didn't find a way of actually bypassing the VAT increase and finding other ways of saving on expenditure. At the end of the day, the nub of the issue is that the country has been asking itself, why put this burden on taxpayers when for many years people have been calling for action against corrupt practices and wasteful expenditure, and the government has not actually done anything about it. And now from within the GNU, from the very start, the DA's premise was, why do we need a VAT increase when other areas of government spending can be cut back and have been wasteful? And we were not talking about a huge amount of money, really, in the broader scheme of things. 13.5 billion rand. It was less than 0.5% of the annual budget. So, the idea was surely one can find ways of finding an extra 0.5% of worth of savings in government expenditure here and there. And many political parties, including the DA, had made some suggestions as to where these savings could be made. I happened to read a little article yesterday that said that the security of officials on its own amounted to a cost of 2.5 billion rand. So that, the VIP security and that sort of thing, it's 2.5 billion rand. So there's one area that can really be saved upon.
So one could argue also that in light of the recent attempted assassination, as it were, of our deputy president here in this country, that maybe that is something that needs to be looked at again. I don't know. But Azar, you said the finance minister withdrawing this case, avoiding the embarrassment of losing in court. One could argue that the entire process has already been quite embarrassing, and that the minister has got quite a bit of egg on his face as it is and as it stands right now, because he faced so much resistance to this process initially back in February when the budget was initially postponed. He's talking about 75 billion rand that needs to be plugged, though, in terms of the funding gap. So let's maybe just talk and unpack further where you reckon this could come from. You mentioned security and other areas. In your view, what would be the easiest find? Just given the fact that he said that the reason why VAT was chosen as a route is that it addressed the country's funding needs urgently, as opposed to other paths.
Yes. From an urgent point of view, you know, again, urgency is in the mind of the beholder here. The fact is that the government, it's not a huge amount of additional, again, large sums of money, but in relation to the total budget and the total borrowing requirement, there is no harm in actually borrowing a little bit of money extra in the very short term if you don't have the cash.
And those were the stories making headlines down south of the continent. It's back to you, Akin.
Many thanks for the update there, Karabo. Let's join Abi in Kigali as he gives us updates from East Africa.
Thank you, Akin, and a very good evening to our viewers. The East African region has been abuzz with interesting twists and turns in Ethiopia and Rwanda. We start off in Ethiopia, where the country is anticipating to spend less on debt servicing following the country's recent debt restructuring agreement. The country's finance minister held talks with IMF managing director on the sidelines of the spring meetings in Washington, D.C. Well, I spoke to Mered Fikiri Yohannes to unpack that and much more as the central bank announced results of the foreign exchange auction.
The delegation of the Ministry of Finance, including the central bank and also the macroeconomical team, is currently in discussion with the IMF directors and also with Ethiopia's creditors, more importantly, right? So far, as you rightly mentioned, that Ethiopia has gotten $3.5 billion of a debt pause as part of restructuring its debt in the next coming 4 years. So this debt pause would save Ethiopia to pay $3.5 billion. So basically it will alleviate the commitment it will have in the next coming 4 years. So mind you, the reason of the next coming 4 years is because the IMF program is planned to be completed in the next coming 4 years. So as part of floating the currency, restructuring the macroeconomic imbalances, this would give a lot of room for the government, and instead of servicing the debt, it would give a lot of room for a capital expenditure also, and also other subsidy programs the government is trying to alleviate some of the shock of the economic reform. So currently, the $3.5 billion has come in principle as an agreement with the G20 credit committees, which is currently chaired by France and also China. So the outcome of this spring meeting is the delegation is currently discussing with each of Ethiopia's creditors and also with the committee, so that to announce an MOU, a memorandum of understanding, that encapsulates the $3.5 billion of debt restructuring, and more importantly, the Ethiopia's also the private creditors, which also hold $1 billion of Eurobond. So it is one of the most anticipated MOU announcement, because this would give a final say in terms of Ethiopia's commitment it will have in the next coming 4 years, and then it will have a clear show what would be the commitment of Ethiopia's after 4 years, after 2029, in terms of committing its debt, servicing its debt. So as a big announcement, as you mentioned, the delegation is extensively discussing with the committees and also with with individual countries as well.
Well, quite well put out, Mered. And looking at the big picture, of course, as the diaspora remittances have continued to improve, we've also seen Ethiopia's exports have been inching upwards. What has this translated to in terms of the local currency? And of course, this is one of the areas that the IMF has been very vocal in terms of Ethiopia devaluing its currency. But this, on the one hand, might be able to serve to the reform agenda of the country, but on the other hand, it has a heavy toll on the locals when their local currency is heavily devalued.
Absolutely, yes. When Ethiopia started the macroeconomic reform 9 months ago, back in July 2024, it's floated its currency. So it comes with double-edged sword, right? From a macro picture perspective, the country has significantly improved its balance of payment, right? Mind you, it's not. It's hard to say that it is. We floated the currency in the official market. However, mind you, people used to trade on the black market rate, which used to be 120, 125 per, right? Sort of what happened 9 months ago is the official market corrected itself and captured the market. It has corrected its price and sort of eliminated or reduced the gap which is being traded on the black market, right?
And now back to Rwanda. German automobile manufacturer Volkswagen is expanding its operations in Rwanda from local assembly to mobility services and e-tractor projects. CNBC Africa's Eric Shaka spoke to Serge Kamuhinda, CEO of VW Mobility Solutions Rwanda, to find out more.
Since we started, basically 2018, we've been able to launch more than 10 different vehicles, and we have now a fully fledged mobility services that is offering ride-hailing, airport shuttles, and corporate car sharing. We also provide these products to government entities, and we have now embarked on a journey to electrify our fleet, and I think we have also showcased what can be done in terms of innovation with our electric tractor project. We are going in June to officially inaugurate it. It's already working. We're already servicing farmers with electric tractors, but we'll be do the official inauguration of the hub that is being constructed in June. So I think in this number of years, despite the 2 years of the COVID pandemic, I think it's a decent progress, but most importantly, we want to do more, and that's why we're here.
You want to do more. It's been quite a progress, but we also want to know how has been the response, the market response, especially from a Rwanda market perspective.
The response has been good. From the start, what we wanted is to create an enabling environment for new car sales. So, for example, when you say ride-hailing, our ambition is not to say that we will be the ones only providing the service. So, for example, now, 3/4 of the cars you see in Move today are not owned by us, but are cars that we have sold to individuals, and they bring back the cars in the fleet, and they earn money with the cars. And for example, that partnership called Move Plus has worked very well. We have also cars that we are using in conference tourism, because as you know, our country has a strong MICE industry that is also working well. We have cars in commercial vehicles, pickups that are working well. And now the country is shifting more and more towards electric vehicles. And we will be launching soon our ID4, which is an electric SUV, and we'll be launching more electric vehicles.
Yes, a lot of these new cars are looking at the Rwandan market, considering that most people still prefer to use and buy these used cars. It has a huge market here on the Rwandan market. What are you trying to do to, step up and overcome and start being the preferred choice of people buying cars?
Yes. So there are different things. What we also we're going to pilot towards the end of the year is asset financing. We've hoped to work with banks on the acquisition of cars. It has not yielded the success we wanted. So we will be trying out a more innovative asset financing solution. However, I must say that used cars in general is normal. The problem is when you have used cars that you're importing and that have been that are very old. What we are trying to do is to have a used car market for cars that have been locally assembled and that are not very old. So, for example, when we use the cars in the mobility fleet, after 2 years, we sell them and they become used cars, affordable, but that are not very old and that have been locally assembled.
Those were the stories making headlines down in the Eastern African region. It's back to you, Akin.
Very insightful conversations there. Many thanks, Abby. Now let's move over to West Africa, where Nigeria raked in 6.9 billion naira from mining fees in the first quarter of this year. Now that's according to the country's Minister of Solid Minerals Development, Dele Alake, highlighting one of the initiatives on the horizon is the establishment of the Nigerian Solid Minerals Corporation, which is expected to serve as a special purpose vehicle to elevate Nigeria into the global mining arena. Now, Cyril Azobu, partner and mining leader at PwC, explored the investment potential in Nigeria's solid minerals sector. Take a listen.
Is fees accruing from issuing of licenses, basically exploration licenses, small-scale mining licenses, reconnaissance permits, and generally within the quarter. It doesn't really speak to the entire contribution in terms of the fees generated by from the sector in its entirety. So take, for example, last year, contribution to GDP, according to NBS statistics, was about 1.39 billion naira. If you take that on a quarterly average basis, that comes to about 347 billion naira per quarter. But then considering the fees and the figures that have been put out in this quarter and looking at it from previous years. So in 2022, for example, it averaged about 3 billion naira per quarter. And in 2023, averaged about 4.5 billion naira per quarter. So this year's number, about 6.9 billion naira, it's fairly comparable to what has been over the years, except that it's really on the rise. And so if we take a look at what happened between July and December, we had increases in fees, and that may have been a major contributor. However, given the report that the minister did give, yes, there were a lot of new licenses, exploration licenses, small-scale mining licenses for quarrying, as well as reconnaissance permits, right? But then, if you also consider in the last 1 year, there had been a total of about 924 dormant licenses that were revoked. And so if you also then look at the number of licenses revoked compared to new licenses that were issued, it almost compares to about the same. So the question one would ask is, for these new licenses that have been issued, to what extent would they be put to use? How much of the exploration is likely to generate or to convert into real finds economic finds that will actually then put a lot more contribution to GDP. So if we look at conversion rate, according to NAITI statistics, for Nigeria is far less than 10%, which is less than global average.
We move over now to Togo, where S&P Global Ratings has raised its long-term local and foreign currency sovereign credit ratings on Togo to B+ with a stable outlook. And the ratings firm notes that despite headwinds to global growth, it expects Togo's GDP to grow at an average of 6% between 2025 and 2028. Ugo Sobraya, lead analyst for Togo at S&P, joined us earlier to unpack the report.
So we decided to upgrade Togo to B+ from single B. That decision was based on 3 pillars. The first one would be the resiliency of the Togolese economy. If you look at past figures, even amidst external shocks, the pandemic in 2020, then the war in Ukraine, the Togolese economy has remained extremely resilient, with average GDP growth above 6% between 2021 and 2023. And we expect this trend will likely continue in the years going forward. That is because on one hand, you have inflation going down in Togo, which would support household consumption. And we also expect the train of reform that the government has implemented would lift investment, and notably private investment. The second pillar would be the fiscal consolidation at the government level, with deficit dropping below 3% starting in 2026, which would put debt on a downward trend. And the last pillar, the external leveraging of the economy, which reduces balance of payment risks.
And we've definitely seen Togo's fiscal and external imbalances somewhat deteriorated until recently. But talking about how we're also seeing the GDP per capita also move by the year 2028. This is one of the lowest among the sovereigns being rated under your watch at this moment now, looking at less than $1,400 by the year 2028. Can you throw more spotlight on that?
Yeah, of course. So yes, it remains a credit constraint with having a GDP per capita below 1,400 USD. It's one of the lowest among our rated universe. It's significantly below what we see in Benin, with GDP per capita above around 1,600 USD. But at the similar level as Rwanda, which has a similar rating, B+. We do expect the economy will continue to grow. That said, economic justification would be a slow process, and that's why we don't expect GDP per capita to be significantly higher through 2028.
And talking more around the realm of reform implementation and sustaining the momentum now, looking at the upside scenario, you're expecting further diversification of the economy, further support from international donors as well, rapid fiscal consolidation. These look like the ideal picture to tilt towards. But when we look at the likely risks as well, yes, regional tensions have abated somewhat within the region, but Togo still remains a key issue for Togo, especially as a transportation hub. Let's talk about the downside scenarios here, challenges to the prospects ahead.
Yes, as you mentioned, Togo is one of the key transportation hubs in the region, and we've seen some tensions between the countries in recent years, especially between Burkina Faso, Mali, Niger, and the other ECOWAS members. That said, at the time, Togo has played the role of a mediator between those countries and the others, let's say, notably Benin and Nigeria.
And this is where we draw the curtains on this episode. Thank you for joining us on Africa Business Weekly today. Until next time, stay informed and stay ahead. Amaki Obakeye. Bye for now.